Let's get ready to mortgage. He is the prince of programs, guru of guidelines, master of matrices. He puts the fun in funding. Please welcome Mark, Mr. Mortgage Eitel.
All right. Hey guys, it's Mark Eitel here, and you are listening to the Mr. Mortgage Show. And friends, we are super excited to be with you today. We have an action-packed, well, at least a data-packed show for you. It's going to be a great one. We are going to talk about the recent moves in interest rates and what causes that, because clearly it's not the Federal Reserve, right? The Fed has not cut rates, yet interest rates have fallen as a product of what's happening in the overall market. So we're going to dive into that, because if you are looking to make a move based on rate, you need to know which direction to look, because if you're looking to the Federal Reserve, you are staring into the sun and you might miss an opportunity. We're going to cover all of that and get to your questions and comments. If you have questions or comments and you want them on the air, just call or text 855-462-7292. That's 855-462-7292. That is affectionately known as the Anytime Hotline. And Jen is womaning the hotline, and she will get your questions on the air. If you don't want to talk to Jen, which I can't imagine why you wouldn't, you can head over to mrmortgageradio.com and submit your questions there at mrmortgageradio.com. You can't miss it. There's a big orange button that says get your questions on the air. Just click that button, type your question in, hit submit. It'll pop up on our end, and Jen will read it on the air for you. But hey guys, let's dive right in. I alluded to the move in interest rates, right? A lot of people were super concerned with what happened in the stock markets over the last, week and a half, I guess. We saw a 1,000 point drop, as well as several 100-point drops. And trillions of dollars were wiped out of the market. Suddenly, real estate looks like a safe investment again, right? But as a byproduct of that, we saw money move into the bond market and mortgage-backed securities, which drove the price up and the yield down. So interest rates are not controlled by the Fed because he made no moves, right? There was no rate cuts. So why have rates fallen from the mid-sevens to the low sixes so far this year? It's because money moves out of equities into bonds in periods of instability. And as more and more people are doubting the resilience of this market, thinking there may be a recession coming, there's a bit of a flight to safety. And that's pushing prices up and yields down in the mortgage-backed securities market. And that controls the recapitalization costs and current interest rates. So if you really want to track what's happening in the mortgage rate environment, you need to watch mortgage-backed securities. And I'll put a link in the Facebook page for anybody who wants to follow. Mortgage News Daily has a great daily update for the MBS market. And it's a great place to look if you're trying to time the market, because guys, a lot of people missed the bottom this week. We saw people who were considering a refinance in the very low sixes or high fives at the beginning of the week, and suddenly that rate became mid sixes a little bit later in the week because money moved back into equities. So rates change every day, some days more than others, but you need to know where to look if you're looking for an opportunity. And it's not the Fed, guys. The Fed controls credit card rates, auto loans. He controls the overnight rate, which controls the prime rate, which most of the variable rate debt that we have is tied to as an index. So not to confuse the matter, but it's not the Fed who controls mortgage rates. And here's another example of that, what we saw happen this week. I've shared many examples because people have a tendency, including people in the news, to watch the wrong indices when they're looking for movement in the mortgage market. If you have any questions regarding that, just call in or text. I'll be happy to address it further. If you want to have a discussion off the air, I am happy to do that too. I geek out on this stuff and love discussing mortgages and, surprisingly, interest rates. So that's all I have on that. I just wanted to share where to look when you're trying to time the market. Now let's get to some fun facts. Guys, clearly homeownership is a key component to a lot of people's wealth and a lot of people's retirement. We talk about generational wealth passed down through homeownership. I found a chart that I thought was really interesting. the 10 states with the highest homeownership rates. This list might surprise you, starting with West Virginia at 78.6% homeownerships. Nearly 8 out of 10 people in West Virginia own a home. That's mind-blowing to me. That is a huge, huge number, considering that the national average is somewhere in the mid-60s. Followed by Wyoming at 75.3%, Minnesota at 75.1%, coming in at 74.9% was both Delaware and Maine, South Carolina at 74.7%, and New Hampshire at 74.6%, Michigan at 74%, 73.8% was Iowa, and Mississippi, 73.1%. A couple of those states, West Virginia and Mississippi, have been labeled lower income states, but they have a lot of smart people, better than 3/4 of the population on average owning a home. So that's pretty impressive. Now, the 10 states with the lowest homeownership rates also surprised me. Connecticut at 64.8%, Georgia at 64.7%, New Jersey at 64.2%, Texas at 63.6%, Massachusetts at 61.2%, coming in at 60.3% was Nevada, followed by Hawaii at 59.2%, 55.3% homeownership rate in California, 53.9% in New York, and Washington, D.C., a meager 42.3% of the population own a home, which is a bit fascinating considering they're controlling policy on homeownership and interest rates, and they are the lowest homeownership rate in the country. I found that pretty interesting. Take it as you will. I hope your state was on the first list and that the majority of residents own their home, because that seems to set people up for a stable future, whether it's tapping equity to refinance and pay off debt, or it's a reverse mortgage in the future, or just selling and downsizing and living off the equity wealth. We see a lot of that happening as the population continues to age. So congratulations if you were in the top 10 of homeownership. I just wanted to share that list. I found it interesting. And there were a ton of articles released this week about refinance rates jumping. And I can tell you that we are seeing that as well. A lot of people are looking to refinance their interest rates. Some people near the 8% mark if they bought at the peak of the market last year. They're looking to capitalize on this little dip and get something in the 5s or low 6s. So wasn't surprised to see all the CNBC articles regarding refinancing. That is holding true in our practice. And what seems to be triggering the majority of refinances at the moment are credit card debt and car payments. A lot of people are still super upside down with their COVID-era car purchases, and they're looking to refinance that payment away and try to capitalize on these slightly lower interest rates. And if you want to do the math for yourself, head over to RECREFI. That stands for Refi, and REC is reduce, eliminate, and consolidate. So it's a debt consolidation calculator, recrefi.com. You can plug in your debts, plug in the interest rate of the day for a mortgage, and see if it makes sense for you, because we're talking to more and more people each week, and these numbers are starting to get impressive. We're seeing savings from several hundred a month to a couple $1,000s a month by simply capitalizing on today's lower interest rates. So it might be worth it for you too if you want to check it out. There's no obligation to use the calculator. You don't have to sign up. It's like everything else. We're just providing a service for the listeners. So check out recrefi.com. Hey guys, you hear the music creeping up behind me? You know what that means? That is my cue. We'll be back in a few. Sit tight. On the other side of this very short break, we'll be back to answer your questions and continue the Mr. Mortgage Show. Sit tight. We'll be right back. Hey, it's Mark Eitel, host of the Mr. Mortgage Show, and I'm going to interrupt this commercial break to ask you for a favor. If you know any friends, family, coworkers, or the guy in front of you at the grocery line who's talking or thinking about buying or selling or refinancing real estate, I'm hoping I can count on you to help me spread the word, introduce them to me, to the team. You can do that by simply sharing MrMortgageRadio.com. That's MrMortgageRadio.com. Guys, it's Mark Eitel, NMLS 1929005. Now, back to the commercials.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And guys, if you've got questions, shoot them over to us, 855-462-7292. That's 855-462-7292. That's the Anytime Hotline. And Jen is standing by, womaning the hotline. She'll get your questions on the air. And I know we've already got a couple that have come in because she's given me the signal. And guys, it's not that signal. It's a thumbs up. It's not that finger. She's holding up a finger, but not that finger.
Let's get this party started.
Okay, I'm ready when you are. Throw me question number 1.
Connie is asking, what is the minimum down payment for a first-time buyer? Can I use my tax refund as a down payment?
Hey, Connie, that's a great question. So let me start with the second question. Yes, you can use your tax refund. And as a matter of fact, I shared a story, I think it was last week, of a young married couple who during the pandemic had to move back in with her parents, and they have made the best of it, but they're ready to go out there on their own, and they're using their tax refund as their down payment. And both sets of parents are helping them with gift funds for their closing costs. So absolutely, source of down payment is fine if it's going to be the tax return. Absolutely. And it's a great use of a tax return. And then to answer your other question, there are first-time buyer programs with as little as 0% down, I'm excited to say. So if you don't qualify for one of the grant programs that enable you to borrow 100% of the purchase price, then figure somewhere between 3 and 5%. Most likely it's going to be 3 or 3.5. FHA is 3.5, and it's a great program for first-time buyers. Has a wonderfully beneficial interest rate compared to conventional. And the mortgage insurance component of FHA has recently been reduced. So it is a great option for first-time buyers. And there are many, many grant programs out there that will gift or loan that 3.5%. So it's a good place to start. But I appreciate that question. Hey, Jen, do you have another one?
Yvonne has this question. I've heard talk about permanent payment buy down and a 3-2-1 buy down. Can you explain the difference? They both lower the payment, right? Thanks.
They do both lower the payment. So the interest rate on the 3-2-1 buy down is 3 full % lower the first year, 2% lower the second, 1% the third, and then it goes back to where it started. So let's say, just for round numbers, the rate of the day was 6.5%. Year 1, you would be making a payment based on 3.5%. Year 2, 4.5, year 3, 5.5, and then it would go to 6.5 and stay there for the rest of the loan. Now, the permanent rate buy down won't move that far down, but it never adjusts. So you might take a 6.5% loan and buy it down to 5.5 or 5.25, or maybe get lucky and grab a 5% rate. But the nice thing about the permanent rate buy down is it starts and stays in that instance at 5 or 5.25, whatever you buy it down to, and never adjusts again. I personally prefer that option because I'm a little more conservative and I don't like a payment that increases over time. I'm a big fan of that fixed payment for the life of the loan. So, but they both lower your payment and they're both a great option. Now, with the 3-2-1 buy down, you're going to qualify on the fully indexed rate, if you will. So you would have to be qualified at 6.5%, even though that first year your payment is based on 3.5%. With the permanent rate buy down, you're qualified at the lower rate because it never adjusts. So I hope that makes sense. That part gets a little bit confusing for people sometimes, but I would be happy to spend some more time with you if you need more info. But I appreciate that question. If anybody out there has questions regarding that and would like to go a little deeper, give us a call, 855-462-7292. As I mentioned, that rings here when we're in the studio on the air doing the show, but it also pushes to my office when we're not. So that's a great way to get us, or check out MrMortgageRadio.com. All our contact info is on that page as well. But hey, Jen, let's get another question in. Are you ready?
Larry has a question. We're selling our house in Boston this summer and moving to Florida. We both have jobs lined up. How soon after we move can we buy a house? Is there a waiting period because of new jobs?
Hey, this is a great question, and I want to take a second to explain it. So, Larry, thank you for that, my man. Wonderful question. So a lot of people get this one wrong because we're all conditioned to believe we need 12 or 24 months employment history before we can qualify, which is true, by the way. The part that gets people confused is we make the assumption that that has to be on the new job with the new company, right? So here's something that's pretty interesting. If you're staying in the same field and your job is similar to the job you have now, then you may not have to establish 12 months work history in the new location. Now, the best way I can explain it is to give you an example. We are working with a couple right now, young family, relocating from Pennsylvania to Northeast Florida. She's a school teacher and he's a sales executive. She's transferring from the school district in Pennsylvania to a school district in Florida. She's a teacher. We have a shortage of teachers all over the country. We know that's not going to be hard for her to get a job. As a matter of fact, her new position is already secured, which is the key element to this strategy, if you will. He's going to work for a competitor. He would have stayed with his current company, but they don't have a facility in Florida. So he's going to work for a competitor in the same role, being paid the same way, and a little bit more money on his side, a little bit less money on hers. I guess Florida teachers don't make as much. But here's the thing. They're moving from Pennsylvania into their Florida house. They're closing on the house before they even put 1 day's worth of work in on the new job. They've got their employment letters in place. The jobs are in the same industry. They've already established a successful work history in those industries, in those positions. So I share that because you might be able to make the transition the same way, where you just relocate directly to the Florida house and start the Florida job, the week after you close. So, but brilliant question. If anybody out there needs more info about that, give us a call, shoot us a text, shoot us an email. I'll be happy to spend some time with you and explain it in detail. But you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight on the other side of this break. We'll be back with more of the Mr. Mortgage Show. So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at mrmortgageradio.com. That's mrmortgageradio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at mrmortgageradio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel. This is the Mr. Mortgage Show, and you heard the man. If you've got questions or comments, you can call or text 855-462-7292, 855-462-7292. That is the Anytime Hotline. And Jen, my producer, is womanning the hotline. She'll get your questions on the air. And hey, guys, we call that the Anytime Hotline because it rings here in the studio when we're on the air, but that also pushes to my office. So if we're not on the air and you need us, you can also use that number, 855-462-7292. And the easier thing to remember is mrmortgageradio.com. mrmortgageradio.com. All our contact info is there, but there's also an email icon on the bottom of that page. And if you've got questions or comments, you can shoot them to us via email by visiting mrmortgageradio.com and hitting that email icon, and Jen will get your questions on the air. But I am going to throw it over to her. We've had some good questions right out of the box, and let's see if we can't keep this going. What do we have, Jen?
Joe sent us this. How long does a rec refinance take? If we start the application next week, what's a realistic timeline?
Hey, Joe, that's a great question. So the rec refi takes no longer than any other mortgage transaction. So we're closing those in somewhere between 21 and 30 days pretty regularly. If it's a very obscure or a rural property that requires a little bit more time on the appraisal, that might push closer to 30 days. But a rec refi should take 30 days or less. And I hope that answers that question. And hey, guys, if you're curious, the rec refi, REC, stands for reduce, eliminate, or consolidate. And we're using that refinance loan program when you're paying off credit cards or paying off a car payment. You're consolidating some debt and you're reducing your overall monthly outflow. That is a great loan program designed exactly for that. I share a story all the time of a gentleman whose mortgage interest rate did indeed go up almost 2 full percentage points. But he paid off a couple truck payments, some credit cards, and his monthly expenses went down significantly. So that extra cash that he's saving every month in overall expenses, right? The mortgage payment went up, but everything else is gone. That's what he needed to get back on track. So yes, a lot of people are under the assumption that the only time it makes sense to do a refinance is if you're lowering your interest rate. But guys, people refinance for a lot of reasons. And you hear that spot that we run occasionally during the show. I mean, whether it's cashing out to put your kids into school and you need tuition money or unforeseen medical expenses, or a lot of people right now are pulling cash out of their home and using that equity to go buy rental properties because the rental market is so very strong right now. So brilliant question. I hope that helps. If you need more info, you can reach out to us. But I appreciate that one. Hey, Jen, what else do we have?
Stephanie is asking, my sister and I want to buy my aunt's condo. I think it's worth around $400,000, but she will sell it to us for $300,000. Can we finance the whole $300,000? Thanks.
Hey, Stephanie, that's a great question. My mind instantly goes to gift of equity in a situation like that. Use the gift of equity strategy. So to answer your question, yes. And the way that would work with a gift of equity is you could write the purchase contract at $400,000 and she could gift you $100,000, which would put your loan to value at 75%. And that would alleviate the need for mortgage insurance. She could gift you the full $100,000 and then you're financing the entire $300,000. She can gift you the closing costs also. So that would be a strategy that would allow you to get into the transaction with no money out of pocket. And if you need help with that, give me a call. I'd love to explain that to you in detail. But it sounds like you've got an amazing opportunity to, one, buy a property with instant equity and to finance the entire amount. So what an awesome opportunity. And guys, one more reason why somebody's decision long ago to buy a property is making all the difference in the world now, because Stephanie's aunt clearly has built up enough equity to make this work. So brilliant question. I hope that helps. If you need more information, we are here and I'm happy to jump on a call with you. But thanks for that, Stephanie. Hey, Jen, do you have another question?
Rhonda sent us this one. I want to buy a triplex and live in one apartment and rent the other 2. Can I count the rent from the other 2 apartments to help me get approved?
Wow, you guys are amazing this week. Another fantastic question. And kudos to you for looking at this amazing opportunity, because with a triplex or a duplex or a fourplex, so 2 to 4 units, you can utilize an FHA loan or a conventional loan with primary residence guidelines, meaning you could borrow 96.5% with FHA or 97% with conventional lending and buy an income producing property. Now, the caveat is exactly as you mentioned, you have to live in one of the units to qualify under those guidelines. But man, what a brilliant way to live for free or close to free, or in some instances, even make money. So way to go. And to answer your question, yes, the rental income from the other 2 units can be utilized as income when calculating your debt to income. And there's ratios and calculations that need to be applied, and I'm happy to spend more time with you. But to answer your question, yes, the rental income will help you qualify in a scenario like this. So well done. That's a brilliant opportunity and a brilliant strategy. And I'm very excited for you. Way to go. Hey, Jen, can we get another question in?
Sophie wants to know, I got an offer to buy my house. They want me to sign the deed to them and make monthly payments. The payments are much more than my current mortgage payment, but this seems fishy. Is this legal?
Oh boy. Okay, Sophie. First, I'm not an attorney, so I'm not going to say legal or not legal. I've heard people argue both sides of that one, but I'm going to tell you what I don't like about this from the seller's perspective. So you'll hear this called a sale subject to mortgage or a wraparound mortgage, right? So you're keeping your current mortgage in place and the buyer's either paying it for you or they're paying you a larger amount that enables you to pocket the profit and make the mortgage payment, which is tempting. But here's the challenge. If you deed the property to them, they now own the asset, but you own all the debt. You're on the hook for the mortgage. So if you deed the property to them and they never make a payment and that property goes into foreclosure, guess who's going into foreclosure? You. Guess whose credit is damaged? Yours. So I never, ever, ever like the idea of giving up ownership of the asset and keeping ownership of the debt. And people will often do that with what's called a quit claim deed. So I don't like that. And then secondly, almost all, I'm guessing all at this point, residential mortgages have in them what's called a due on sales clause, which means once the ownership interest of the property changes hands, your mortgage could become payable, your current mortgage. So not a fan of this from the seller because you assume all of the risk. I'm not a big fan, even if they're giving you a big lump sum up front that's super attractive. So if you want some ideas about other workarounds, ways that they might be able to qualify, I'd be happy to help. But great question. Just not a fan of this as a seller. As a buyer, it's a big win. So anyway, you hear the music, you know what that means. That's my cue. We'll be back in a few. Sit tight. On the other side of this break, we'll be back with more of the show. And Sophie, if you need to talk, give us a shout. But sit tight, guys. We'll be right back. Raise your hand if you are freaked out by what's happening in the banking world. Well, no, put your hands back on the steering wheel. It's all starting to feel like a house of cards. And what about that $17 billion, yes, billion with a B, dollars worth of bondholder money that was lost in that Credit Suisse takeover? Right now, I'm hearing more and more people talk about a flight to safety, and they're looking at gold and silver and other precious metals, but also rental property. Yep, income-producing rental property is starting to become sexy again. Guys, we've got an amazing loan program called the Landlord Loan. It's an easy way to acquire rental property. If you've got good credit and the assets, we don't even look at your personal income. We look at the income produced by the property. Assuming that it supports the debt, boom, you're a landlord. Check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005, and my team and I are here and happy to help. Check us out at MrMortgageRadio.com.
Welcome back to the Mr. Mortgage Show. Call us now at 855-462-7292.
All right, we are back. My name is Mark Eitel, and you are listening to the Mr. Mortgage Show. And friends, you're in the right place if you want the answers to your questions, the data, the tips, the tricks, the inside information that you need so you can make better real estate and mortgage decisions for you and your family. If you've got questions or comments, get them on the air by calling or texting 855-462-7292. That's 855-462-7292. That is the Anytime Hotline. And when we're not in the studio doing the show, that number rings to my office. So you can get us anytime on that number, 855-462-7292, or check out MrMortgageRadio.com, MrMortgageRadio.com. Scroll to the bottom of the page, click that email icon, and you can send over your questions via email. So, man, we've had some amazing questions so far. You guys are bringing it this week. A lot of really, really good questions, and I certainly do appreciate that. But speaking of your questions and speaking of Jen, let's keep this rolling and throw it over to Jen for another question. Hey, Jen, what do you have?
This one is from Shane. Okay. Is there any way around the new credit score penalty fee? I know enough to know not to tank my credit to get a better deal, but will they overturn it soon?
Hey, Shane, that's a brilliant question, my man. I don't think so. I've never, ever seen the government undo anything as far as taxes or expenses, or it always seems to be the spiel. I remember when I was a kid hearing my grandfather talk about the Florida Turnpike was going to charge tolls until the road was paid for. Well, guys, I'm an old man, and there's still tolls on the turnpike, and I'm pretty sure that it's been paid for a few times by now. So to answer your question, I don't think it's going to be rescinded. I know a lot of people are up in arms about it. There are some workarounds. So there's some creative strategies around it. I would need to know your specific scenario to see if any of it applied to you. But I would just, as frustrating as it is, I think they're here to stay for now, and just be as creative as you can to work around it. And we've got some strategies in place I would be happy to share with you. But I appreciate the question. If you want to talk a specific scenario through with me, just give me a call or shoot me an email. I'll spend some time with you and we'll figure out a workaround. We're doing it every day for our clients, and it's proving successful. So we're pretty happy with coming up with strategies around it for the time being. But anyway, I'm going to throw it over to Jen. Hey, you got another one?
Nora sent an email. I thought I could only refinance to lower my mortgage rate. But if I heard you correctly, that's not true?
Hey, Nora, thank you for paying attention. I wonder sometimes if I'm the only one listening to the show, but you're right. A lot of people think you can only refinance if you're lowering your rate, therefore lowering your payment. And we talked about a scenario earlier in the show where a gentleman is using the rec refinance to pay off a bunch of debt. And yeah, his mortgage payment's going to go up, but his overall monthly expenses are coming down a lot. And because of that, it makes sense for him, even though he's increasing his rate. And Nora, that's your equity. As long as you qualify for the payment, you can pull it out for any reason. You can take it out to go to Vegas if you wanted. I mean, I wouldn't advise it, but you could. A lot of people will pull equity out to use as a down payment on an investment property, or as we mentioned, to pay off debt or some medical expenses, or if they've got college-age students and they want to use it for tuition. You can use that equity. That's your money. You can access it and use it for whatever you want. So increasing the interest rate does not prohibit you from refinancing. Now, you definitely want to look at all of the options and make sure it's a fiscally responsible decision, because, it's not just a one and done. You're making that payment for a long time, but it's your money, and people access their equity all the time to make some strategic moves in life. So brilliant question. And thank you for catching that, because I do find a lot of people make the assumption that refinancing is only permissible, not even advisable, but permissible if you lower your interest rate. And that's not the case. So great question. Thank you for that, Nora. Hey, Jen, do we have another one?
Brianna's asking, how hard is it to assume an existing loan? I found a house with an FHA mortgage at 3.125%, and the seller says I can assume it. How do I get started? Neither of us have a real estate agent.
Hey, Brianna, that's a great question. And now's a great time to do this. So to assume a loan, you contact the servicer, and the servicer is the company that the seller is making their mortgage payment to right now. So you don't start with a bank. You don't even start with someone like me. You start with the servicer, because they have to approve you under the terms of the current loan, because they're going to essentially transfer that loan into your name. So the jumping off point and this applies to any assumption, guys, it's the servicer, not a brand new lender, not even the original lender, because oftentimes that loan was sold, sometimes many times since it was originally originated. So call the servicer. So whoever the seller is making their mortgage payment to, there's a number right on that statement. There's a number when they log in. You, as the new buyer, if you will, call that servicer to start the process. Now, one thing to keep in mind, it's not a fast process. If a new loan takes, 21 to 30 days, this is going to take longer, sometimes 6 weeks, 8 weeks sometimes an assumption can take, because the servicers aren't originators. They're not built to originate new loans. It's just they don't have the workflow smooth. It doesn't happen often enough that they have a full-fledged assumption origination department. So just know the process is a little clunky, but it's a brilliant, brilliant time to take advantage of assuming, in this case, an interest rate in the very, very low threes, which is amazing. But another thing to keep in mind, guys, you're assuming that loan exactly as it exists, meaning the remaining balance and the remaining term. So let's say you're buying a house for $500,000 and there's a loan on it for $300,000. That's what you're assuming. You've got to come up with the $200,000 to bridge the gap. And that's where a lot of assumptions fall short, is people are unaware. They think they're just assuming that rate and they're starting over. That's not the case. If there's 23 years left, if there's 17 years left in the mortgage, that's your term, and the principal amount is assumed exactly as it exists today. And again, that's where a lot of people get wrapped around the axle, because to use that example that I just did of a $500,000 house with a $300,000 mortgage, you would have to qualify for the assumption and come up with the $200,000 to bridge that gap. So just know that going in, you're going to want to ask the seller what the mortgage balance is, the principal balance, and then do the math to make sure that you can come up with the down payment to make up that difference before you even start that process, because you'd hate to get, 3/4 of the way into it and realize that you're not going to be able to bridge that gap. And guys, a non-veteran can assume a VA loan. Yep, you heard that correctly. That's another one people get wrapped around the axle. A non-veteran can assume a VA loan. Now, here's the thing. It's not advantageous for the veteran, the selling veteran in that case, because their eligibility is going to be tied up with the assumption of that loan, but it is doable. But yeah, great opportunity to assume a mortgage right now. Just know all of that info going in. And we're here and we're happy to help if you need more info. Well, oh, you hear the music? You know what that means? We have wrapped up another week of the Mr. Mortgage Show. Where does the time go? Guys, I have so much fun doing this with you. Hey, if you need us during the week, check out MrMortgageRadio.com. That's MrMortgageRadio.com. Hey, do me a favor, share the show, spread the word. We're a national brokerage. If you can hear my voice, we could be your choice for a mortgage. So give us a shout. We're here and happy to help. Otherwise, have an amazing week. We'll see you next time right here on the Mr. Mortgage Show.
That's a wrap. Join Mark Eitel next week for more thrilling, edge-of-your-seat discussions about real estate and mortgages right here on the Mr. Mortgage Show.
So you think interest rates have gotten too high to refi? Well, not so fast. There are several reasons people refinance. Sure, lowering your interest rate is one, but there's debt consolidation, home improvement, unexpected medical expenses, pulling out some equity to go buy an investment property. Heck, I even know of one guy who refinanced his house so he could buy his mistress a condo. But let's jump back to debt consolidation for a minute. I'm working with a client right now. His name is Ben. He's going to refinance his house, pay off a host of credit cards and 2 truck payments. And yes, his mortgage interest rate is going to go up, but his monthly expenses are going to go down significantly. And that monthly savings is going to get he and his family back on track. Guys, if you've got questions, check us out at MrMortgageRadio.com. That's MrMortgageRadio.com. My name is Mark Eitel, NMLS 1929005. I host the Mr. Mortgage Show, and we are always here and happy to help. Check us out at MrMortgageRadio.com.